decision going to hit the tape in just about 2 hours' time, 6 p.m, and then the press conference to follow with Janet Yellen at 6:30. So just be mindful of that. Obviously, it's earlier than normal given the US clock change that occurred at the weekend. So we'll get those a little bit earlier than usual. So taking a look at the market so far today, as you would think, it's been very slow going as the markets await this bigger piece of news that's going to hit the tape. And equity markets in the US very much sideways fashion, albeit in moderate positive territory. T-notes likewise just sitting above R1, up around 4 ticks, but nothing too great a direction at this point as people look to that event to guide thereafter. Oil, we had a bit of a mixed picture in the latest DOE. Oil inventories, obviously a drawdown in the headline figure, but just only 237,000, which was smaller actually than what we had in the APIs last night. And so actual upside was limited as well, probably by the fact that the US output was up again, and we've now breached 9.1 million as well. So let's talk about the Fed then, and what to expect today. And one of the key things really that I want to show you is how well really the Fed have this time communicated to the market exactly what their intentions are with the actual interest rate decision specifically for March. Going to get to the forward-looking summary of projections shortly. But for March, what you can see here is basically the furthest left on the graphic defining the beginning of February, and the furthest right all the way to where we are today. To where we are today, we are 95% or so priced for the Fed to hike interest rates by 25 basis points later on this evening. If you look at the purple line, that's just flatlined. However, it's actually ticked higher the last 2 or 3 days. So actually, there is a very, very small portion of market pricing that's looking for the potential of a 50 basis point hike. Now, I would say that would be super hawkish if that happened, and I do not think that that will occur tonight. But there's some very small, minor outside bets that there are even more. They're breaking that kind of traditional 25 basis point increment, and they go for something a little bit more punchy. What you can see then is here the Fed members and how they've managed this expectation, because if we go back to February, actually the possibility at the beginning of Feb of a 25 basis point hike in March was pretty much not going to happen. It was about 30%. And so as we've gone through, after Yellen's testimony, Dudley and Yellen speaking, and really it's really kicked off at the beginning of March. You had Kaplan, Harker, Williams, Dudley, all being extremely hawkish, talking about the need for action and so on and so forth. Brainard was a really critical one as well, because as we've discussed before, she tends to err leaning on more the side of being dovish. So her then move to joining the hawkish camp was significant for that reason. And then Yellen ratifying it almost, what the Fed's intentions are, and then cemented by a pretty strong non-farm payrolls report that we saw most recently, keeping the Fed on course then from an economic point of view. Looking at the data, because that's important to set the scene, and I'm only going to look at a couple of the headline readings that we've had. And talking of non-farm payrolls, that was 235,000 when it came out for the month of February. So that was above expectations of 190, so a very clean beat. That came after a very strong January print as well. So the Fed are very happy with the current situation here in terms of job creation in the US. In terms of, I've just picked out ISM manufacturing PMI, which is one of the key bellwether readings, and I've picked it because I just wanted to show you here the incremental increase. And obviously with the PMI reading, 50 is the key measurement between expansion or contraction, and we've been moving higher really ever since the third quarter going into Q4 of last year, all the way up to 57.7, which in fact is the highest reading since August of 2014. Rising new orders and production while employment has eased, and that was at the time also above expectations, so strong in that regard. If you're looking at the consumer, well, consumer confidence, this is the Conference Board website, consumer confidence in the US increased in Feb and remains at a 15-year high. And then the one thing, though, that maybe doesn't look quite so healthy, but I think is definitely not enough to change the hand of the Fed at this point, is the GDP. As you can see here, we went from 3.5%, but these last readings that we've had to see out the end of last year have decreased to 1.9%, and we've actually just had the release of the Atlanta Fed GDP tracker, and that's a forward-looking measurement of looking at real-time economic data as it comes out in the US. Basically, it generates then into a model which punches out a forecast for forward-looking quarter of GDP, and that's actually tracking at 0.9% now. So that's actually down here. So US growth has slowed somewhat. But the other key measure, and the one that we've been monitoring a lot from an economic data point of view of late, and data of which actually did come out just earlier today, is that of inflation. And the headline PCE inflation, so the personal consumption expenditure index, is the key kind of bellwether of that measurement in terms of what the Federal Reserve officials are looking at. The two lines that you have here are the headline, which is the orange line, is the PCE inflation, and then you've got the core reading as well. Now you can see the headline is picking up with a lot steeper upside movement, but also on a gradual incline after flatlining through much of 2015, is the core measurement. And of course the Fed's target is to see this number back up towards 2%, and the closer we get to that, the more emphasis then there is for the Fed to take action when the other areas of the economy, such as the job situation we were just looking at, are fairly robust at the moment. So are a lot of the state level manufacturing data, Philly Fed, Empire we've had today, and then things like the ISM readings as well have all been pretty strong, to a point where the Fed are pretty confident that the economy is at a point to handle an interest rate rise. As I speak, just seeing the S&P just squeezing up here to R1, but very quiet going. I wouldn't be expecting any size move above and beyond here. There's going to be a lack of people wanting to commit to the market this close to the main event. So I'd be expecting volumes to decrease, liquidity to thin out going in towards the announcement is typically what you see. Okay, so a couple things then, looking specifically at this announcement. What does it look like and what we're looking out for? First is then, let's talk about the interest rate rise and the format of the Fed's delivery. Now, normally you would think the Fed hiking would be a big deal. And actually, because of this very good communication that the Fed have done over the process of the last 6 weeks, means that the market is now fully priced for that event to happen. So when it does occur, actually that's just in fitting with expectations, and actually there is fairly contained, if not minimal, price reaction to that event. Now, what the bigger thing is that we're going to look for are a couple of things. One, the statement that comes out alongside that of the rate decision. This is when you use that tool on the Wall Street Journal. It's called the Fed Statement Tracker. And this is where when the clock strikes 6, this will be able to refresh. This will move to February on the left here, and the right-hand side will move to today, March, and it will basically strike out anything that's changed and put the new part in this green bolded or coloured highlighted words that you can see. Here, what we'll be looking for is what is the Fed's kind of assessment of the economy. The way economic data has been, you would think they have room to be confident about the developments that they've seen and also about the economic future moving forward. So this is key, and we'll be looking at some of these very subtle word changes that might be evident, particularly on how they see inflation would be interesting, the job situation, overall sentiment as well, to be monitored. So that's kind of part 2. So you've got the Fed hike, the statement. The other thing that you often hear mentioned, and the thing that could arguably be what would capture the biggest short-term movement, is what's called the Economic Summary of Projections. And so if I go to the Fed website, what you'll see is the structure of all their meetings for 2017. But importantly, what you'll see is a little asterisk, which denotes the fact that on March, June, Sep, and Dec, you get an update to the Fed's forecasts. These are basically forecasts surrounding GDP, unemployment, and of course, that important PCE number that we were just looking at. From this, they then also derive a federal funds rate median projection. This then being all of the Fed members, what is the median number of which that they foresee at the end of that year the inflation or the interest rate being. So then by default we can plot a curve of the trajectory of interest rates going forward from 2017, 2018, 2019 and then the longer run. Then the market can reprice itself on whether or not it's positioned correctly or it needs to be more hawkishly priced or dovish and vice versa. So these are really key things that we'll be looking out for. This is what the actual report looks like. And so those 4 meetings we get a year, this being one of them, March, is very important because we get an update from this is what you're looking at. It's a December summary of economic projections. We'll get a completely fresh report 3 months later. And obviously when they did this last report, that was when they did hike rates for the first time in 12 months. Alongside this, of course, you'll get the press conference with Janet Yellen. But before we get into the crux of that, let's just have a quick look at what the dot plot matrix really looks like. Now, if you actually scroll down in that report I just showed you, let's just go back to it. It has some fan charts, but then it has the actual dot plot matrix within it. Now, I've picked out this one from Business Insider because I think it just looks a little bit easier to see what's going on here. And what you've got, this is what was released in December. So December is the, let's just call it green on the right hand side for each period measured. The red on the left hand side was what we had when the prior projections to that were released in September. Now each dot defines a Fed member. Some more dovish, some more hawkish. And then you have the overall median, which has been bolded in this particular graphic. By this then, what I can determine just visually looking at this dot plot matrix is that 2017, what the Fed have done is the median has moved up from where you can see here, from between 1 and 1.25%, it's moved up to 1.25% to 1.5%. So the Fed are now foreseeing in 2017 higher rates by the end of the year. Therefore, they've become more hawkish in their projection of interest rates. You can see they've also done the same, but only slightly in terms of 2018, 2019, and pretty much as was the same for the longer term. This is then what could define and shape the bigger market movement. The Fed is expecting the hike, or the market is expecting the Fed to hike. The statement should show an underlying feeling or sentiment of confidence. They should be confident. The economic data supports that argument. The thing that we're looking out for is how much change is there within these dot plots. Now, Deutsche Bank pointed out an interesting thing here. They're saying then of the 6 that you can see down here, it would take 4 of those to jump up, join the 4 already there, to bump the median up. And you would think that that's quite a big call to see that many Fed officials moving to such a more hawkish stance. However, they do expect about 1 or 2 policymakers to increase their year-end 2017 Fed funds projections. So you might see some slight alterations in these. The more notable one, though, is looking further out. So Deutsche believe there's roughly a 1 in 3 chance that 2017 median dots go up by 25 basis points to 1.625%, but that the 2018 and 2019 median dots will likely increase. So really, that's what the market's expecting. So, there is a bit of room here for a downside kind of or a dovish surprise, I would say. The market's probably more prepped for the process of it being a hike, which would be hawkish, but priced in, so net neutral if you like. But then you get a confident, positive sounding statement, so that's more hawkish. You get an upgrade potentially to the dot plot projections, which is hawkish. So the question being then, what would Janet Yellen likely sound like when she delivers the press conference? And if it followed that scenario we just discussed, you would think then Janet Yellen would likely be a little bit more dovish or less hawkish than maybe what the communication has been through the more traditional format. She will come out, the market will then probably look to her to be a little bit more cautious, a little bit more that kind of gradual mantra that she's become so accustomed to. She'll probably sound upbeat, but in many respects there's still a lot of other things to look at for the Fed, such as, and probably most importantly, they still have very much a lack of clarity over this Trump situation and the fiscal element on when and to how much of an impact that might have to the US economy, because that will definitely define their policy action as we go through into the latter years, so 2018, 2019 for sure. But if you think about the reasons to be hawkish on the flip side, what really stopped the Fed from following through from what they communicated when they hiked at the end of 2015 was China, that volatility, fears of a hard landing. Then you had Brexit, and so that trajectory, they only fulfilled one rate hike throughout the entire year of 2016, way below what they initially said that they would do at the beginning of the year. The only thing is now, the difference is, despite the political risks, you could say, on the horizon, like France and the Netherlands, which is obviously ongoing today, the market has been in incredibly low volatility. Measurements like the VIX have picked up the last couple of days, granted, but overall it's been near record levels. US equity markets are pretty much at all-time highs. So China as well is not so much of an issue these days, and the Brexit process is going to be a little bit more drawn out, but seems to be just contained at the moment to very much UK assets and the Great British pound in the FX market. So not a lot of excuses for the Fed not to take action and not to sound upbeat. But if that is the case, I'll be expecting Yellen to sound quite more assured and a bit more even-handed, so to speak. That's how I'd probably see it going. So the market then might go initially, there might be strong bouts of volatility. That will then be followed by probably a period of uncertainty for about 10 minutes while people try to understand what it is the summary of economic projections are telling you, i.e. the dot plot. They'll also be looking to digest the subtle changes in the Fed's language. This is when things like algos, if you like, they obviously have a very strong advantage at some points. A binary execution on a piece of economic data, that's when it's at its most potent. But trying to understand a multi-dimensional macro event like this, which is based not on numbers but communication words, is when you guys stand a much better chance when you're interpreting the information firsthand. So a couple different things then you need to look out for. You're going to get that initial blast at 6. That's when you'll get the actual hike. Again, it's pretty much assured that that's going to happen. The most outside scenarios would be no hike. If there was no hike, yields would drop through the floor. T-notes would go hugely bid. The dollar would get slammed, and so major pairs would spike aggressively higher. You'd probably imagine US equities would rally, would probably be the initial thing. If the opposite, and they hiked 50 basis points, then T-notes would probably spike up, or yields would spike up, so T-notes lower. US equities, I would imagine, would probably get hit, would be the initial reaction, because the nervousness that the Fed are getting overtly tightening too aggressively but the dollar would probably strengthen quite aggressively because the market's not factored in such an aggressive move. I must stress though that both those scenarios are extremely unlikely. What you're likely to see is a flash of volatility as the market becomes quite illiquid ahead of that release, and then they confirm the hike of 25. Then you've got to understand the words that you hear, then digest the summary of economic projections. So don't get caught up in kind of the messy price action. I would say try not to second guess it too much. Once you've understood the kind of direction of what it is that the Fed are telling you, the market movement is probably going to, if there is a clear defined assumption, then you'll see that prevail in the overriding trend in the market. Then it turns to Janet Yellen. She'll start at 6:30. She'll normally speak and read out a statement for 20 minutes. Then she'll go to a Q&A for about 45 minutes. Now, much like Draghi, very unlikely she'll put a foot wrong because she's a very experienced person now in that regard. But there is one area that I think you guys should keep an eye on, and she might well be questioned about it, and that is the Fed's balance sheet. Because the Fed's balance sheet has swollen to $4.5 trillion via its crisis-era intervention. So buying basically vast quantities of government bonds and mortgage-backed securities as part of their previous QE programs. So officials have started openly discussing the possibility of reducing the size of their holdings. The Fed seems likely to retain existing language in its statement, pledging to keep reinvesting the proceeds of maturing securities in its portfolio until normalization of rates is well underway. So what you're saying then is that it could be a case that we get a couple of rate hikes underway before then they start to shrink the balance sheet, because otherwise it's going to be too much of a hawkish kind of move for the market to digest. Yellen then likely to face questions about this. Again, any shrinking would be akin to being the Fed hawkish. Any status quo would probably be more neutral. So something to just keep an eye out on the outside. Okay, I don't want to go on too long. I think that pretty much sums up the main things that we're looking out for. I'll leave you with one final graphic, and I did share this with you guys yesterday. This was ING, and this was basically their summary of what to look out for. I'll pop it in the chat room on Trading Live again when I'm finished. But essentially the orange defines their baseline scenario, i.e. the hike, which the market is very much expecting. They're actually looking at the dot plot projections here, and then the economic projections, what they're saying, and then the press conference, what it's like, how she's likely to sound on the balance sheet, where ING are actually saying there's no decision made, discussed, but more work is needed. I totally agree. I think that's the status quo when I refer to that in that way. Okay, so potential then, I'd say most likely is going to be quite hawkish in its first instance. However, could be negated by a more cautious, even-sounded Yellen speech and Q&A in order to make sure the market doesn't run away and take this all too hawkishly. There is, I guess, the next second scenario, which would be not the main focus, but could be certainly a possibility, would be the Fed hike, but then they leave projections largely unchanged and want a little bit more clarity over the fiscal situation, tax budgets and so on, before they can determine whether or not that needs to increase. So really it's about June, September, December. Remember, the Fed are communicating at this point we'll get 3 hikes this year. When are the others going to come? That's the critical point. Okay, guys. Going to be quiet for the moment. Coming into the cash close in Europe in 5 minutes. I'd suggest you get some food, get some water, get some rest, and then be back on it for about an hour's time, and then we'll do the countdown into the main event. Okay, thanks, guys.